Most people think passive income is just a fantasy, but there's one investment strategy that literally pays you for doing absolutely nothing. And in 2026, it's more accessible than ever before. Today we're breaking down dividend investing in the simplest way possible, because this could be the key to building your financial freedom. If you're completely new to investing, don't worry. By the end of this video, you'll understand exactly how dividend income works and whether it's right for your situation. Let's dive in. So what exactly are dividends? Think of them as a company's way of sharing profits with the people who own pieces of that company. When you buy stock in a corporation, you become a part owner, even if it's just a tiny fraction. And some companies decide to reward their shareholders by sending them cash payments on a regular basis. Imagine you own a small bakery with 3 friends. Every month, after paying all the expenses like rent, ingredients, and employee wages, you have some profit left over. You could reinvest all that money back into the bakery to expand, or you could split some of it among the 4 owners. Dividends work the same way, except instead of a bakery, you own shares in massive companies like Coca-Cola or Johnson & Johnson. Not every company pays dividends, though. Many newer companies, especially in technology, prefer to reinvest all their profits back into growing the business. They figure if they can grow faster, their stock price will increase and shareholders will benefit that way instead. But established companies with steady profits often choose to pay dividends because they've already done most of their major growing and have excess cash to distribute. Now you might wonder why companies would give away their money instead of keeping it. There are actually several smart business reasons for this. First, paying dividends attracts certain types of investors who want regular income, which can make the stock price more stable. Second, it signals confidence to the market that the company expects to keep generating profits. And third, it forces management to be disciplined about how they spend money, since they need to save enough to cover those dividend payments. Companies typically pay dividends every 3 months, though some pay monthly or annually. The amount varies based on how profitable the company is and what their board of directors decides. This isn't guaranteed money, though. Companies can reduce or completely stop their dividends if they run into financial trouble. Let's talk about how these payments actually work. The process involves several important dates that every dividend investor needs to understand. First is the declaration date, when the company announces they're going to pay a dividend. They'll specify how much per share and when it gets paid. Next comes the ex-dividend date, which is probably the most important date for investors. If you own the stock before this date, you get the dividend. If you buy the stock on or after this date, you don't get that particular payment. The stock price usually drops by about the dividend amount on the ex-dividend date, which makes sense because new buyers aren't getting that payment. Then there's the record date, which is when the company checks their books to see who owns shares and deserves the payment. Finally, the payment date is when the money actually hits your brokerage account. Here's something that confuses many beginners. Let's say a stock costs $100 per share and pays a $1 quarterly dividend. On the ex-dividend date, the stock price will typically drop to around $99, because that dividend payment is no longer included in the value for new buyers. This brings us to dividend yield, which is how investors measure the income potential of dividend stocks. Yield is calculated by taking the annual dividend payment and dividing it by the current stock price. So if a stock costs $50 and pays $2 per year in dividends, the yield is 4%. Higher yields might seem better, but they're not always what they appear to be. A company might have a high yield because their stock price has fallen due to problems with the business. Or they might be paying out more in dividends than they can actually afford, which isn't sustainable long term. Generally speaking, dividend yields between 2 and 6% are considered reasonable for established companies. Yields above 8 or 10% are often warning signs that something might be wrong, while yields below 2% might not provide enough income to be worth it for income-focused investors. The real magic of dividend investing comes from reinvesting those payments to buy more shares, which then generate even more dividends. This is called compound growth, and it's incredibly powerful over long periods. Let's walk through a simple example. Say you invest $10,000 in a stock with a 4% dividend yield. That generates $400 in dividends the first year. If you reinvest that $400 to buy more shares, you now own more stock that will generate even more dividends next year. After 10 years of reinvesting at 4% annual growth, your original $10,000 investment could be worth around $14,800, and it would be generating nearly $600 per year in dividends. After 20 years, you might have over $21,000 generating over $850 annually. These numbers assume the stock price stays flat, which rarely happens in reality. If the company grows and the stock price increases along with the dividends, your returns could be significantly higher. Now let's be realistic about the risks and limitations of dividend investing. First, dividends are not guaranteed. Companies can cut or eliminate their payments at any time, especially during economic downturns. During the 2008 financial crisis and the 2020 pandemic, many companies reduced their dividends to preserve cash. Second, dividend stocks tend to be in slower-growing industries like utilities, consumer goods, and real estate. While this provides stability, it also means you might miss out on higher growth potential from technology or other dynamic sectors. Third, taxes can eat into your returns. In the United States, qualified dividends are taxed at capital gains rates, which are usually lower than regular income tax rates, but it's still money coming out of your pocket. If you hold dividend stocks in a taxable account, you'll owe taxes on those payments every year, even if you reinvest them. Fourth, focusing too heavily on dividend yield can lead to poor investment decisions. Some investors chase high-yielding stocks without paying attention to whether the underlying business is actually healthy and sustainable. For beginners, dividend investing works best as part of a diversified portfolio, rather than your entire investment strategy. A good approach might be to allocate a portion of your investments to dividend-paying stocks or funds, while also owning growth stocks and broad market index funds. If you want to explore platforms beginners often use, I've included a few optional resources in the description. Exchange-traded funds or ETFs that focus on dividend stocks can be an excellent starting point for beginners. These funds own dozens or hundreds of dividend-paying companies, which reduces the risk of any single company cutting their dividend and devastating your income. Popular dividend ETFs track different types of dividend stocks. Some focus on high-yield companies, others on companies with long histories of increasing their dividends every year, and still others on international dividend stocks. When evaluating dividend investments, look beyond just the yield percentage. Check if the company has a history of maintaining or growing their dividends over time. Look at their payout ratio, which shows what percentage of their earnings they're paying out as dividends. A ratio above 80% might indicate the dividend isn't sustainable. Also consider the company's debt levels and cash flow. Companies with too much debt might struggle to maintain dividend payments during tough times. Strong, consistent cash flow is essential for reliable dividend payments. Starting with dividend investing doesn't require a huge amount of money. Many brokerages allow you to buy fractional shares, meaning you can invest small amounts in expensive stocks. You can begin with as little as $50 or $100 and gradually build your position over time. The key is to start early and be consistent. Dividend investing rewards patience and regular contributions more than trying to time the market or chase the highest yields. Remember that building meaningful passive income takes time. Don't expect to replace your job income overnight. But with patience and smart choices, dividend investing can become a valuable source of supplemental income and a foundation for long-term wealth building. That's dividend investing explained in simple terms for 2026. It's not a get-rich-quick scheme, but it's a proven strategy that can help you build wealth steadily over time while generating regular income along the way. If this video helped clarify dividend investing for you, consider subscribing for weekly videos covering simple investing strategies and personal finance tips. Thanks for watching, and I'll see you next time.